Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today is going to be a little bit different than some of my other videos, although I have done at least one other video like this. I have 7 requests that I think are going to be a little bit shorter kind of reviews or analysis, either because they're too hard or they're just kind of obviously there's something I don't like about them, or there's whatever the other reasons, or I can just kind of analyze, get down to the nuts and bolts pretty quickly about what I think. So this is going to be, I guess, kind of like a lightning round type of a thing, but it looks like I have 7 stocks that have been requested. I think only a couple of these are actually in the S&P 500, but I'm just going to go through them all in here anyway. Let's see here. I'm also going to be using the new beta version of FastGraphs. I have never used it yet, so we'll see if I don't screw anything up too badly or I can find out how to use it. I do have a 25% off affiliate link down in the description if you're interested in giving FastGraphs a try. It's really good for doing these quick reviews of stocks, so you can go through a lot of them really quickly. I do have some videos where I do that on here as well on my channel. As always, this is not individual investing advice. It's just how I analyze stocks. So I'll find a place to put my head here. Okay, we're going to start with Biogen. So pharma companies are always really hard for the type of analysis that I usually do, because I like to look at history and use that as a guide for the future. But because these companies have like patents that either they get in products that like get approved, like drugs that get approved, or they have them that roll off and then like generic competition comes along and so forth, it means that history isn't always like a good guide for the future. Now, if we get to the really big ones, like Merck or something like that, that has a lot of, maybe Johnson & Johnson, they have like a lot of different products that are kind of constantly potentially coming out. Those are the ones I kind of tend toward, and every now and then I'll just take a chance on one of them. But we can see with Biogen here kind of the problem with my approach when it comes to pharma companies, because I usually don't feel like I have any kind of edge when it comes to predicting what's going to be the next blockbuster drug. So I just have to kind of accept that. Now with Biogen, if we were using my typical analysis, and it was, let's go back to 2020, and I was looking at the historical earnings patterns, it looks absolutely fantastic. Now we see the stock is kind of already trading low. The market's probably already anticipating some of whatever's about to happen here in the past couple of years, but it's always also probably there was some M&A there, I'm guessing. I don't see too much debt though. So the market kind of saw most of this coming a couple of years in advance, which they can do when they see that patents are running off, if they only have a couple products out there. Let's look at basic earnings. So, and this probably tells a little bit better story than the adjusted earnings, right? So we can see what happens. The market anticipates this decline here probably in 20, or maybe M&A or whatever that was coming along. Sometimes, these companies aren't dumb. Like they can tell that when they need new products, and maybe they'll go out and acquire some smaller pharma companies or something like that. So if the market sees that whole thing coming, it can trade off ahead of time, which is usually what happens. I'm guessing that with a stock split here and decline in basic earnings, that this is probably some M&A. Actually, I think I remember, I forget which company they bought, but I think I kind of remember it happening. But you can kind of see what's going on here, and then there's this temporary boost, and then now we're kind of on a downtrend, right? With the basic earnings. That's probably telling the real story that the market cares about. You can see the stock price kind of follows that, but we do see adjusted earnings coming down too. So we had these adjustments. Who knows if they were, legitimate or not, like if they were accurate. And then reality eventually kind of has to set in. Maybe they wrote off some losses or something from M&A or whatever. That's the type of thing that generally happens. I haven't looked super deep into Biogen. But basically, this is just too hard. I don't know when this is going to bottom. I don't know what the next couple of years is going to look like. And it looks like the stock is cheap, but it's only cheap if earnings don't stop going down. So I guess the one thing I would probably say is you want some good news and you want this momentum to shift upward. But you can see there's been these false positives all along the way. So to me, I just put this kind of right in the too hard category, and I just try to find things that better fit kind of what I do. All right, next stock, TDW, Tidewater. All right, just glancing at this looks like some sort of energy stock, maybe like a pipeline or something. Yeah, so oil services, I don't know exactly what they do for oil services. This has been a really tough industry to invest in. Even since this period, I've bought 2 oil service companies and I lost money on them both times when I could have made money in other oil stocks. So it did look like we were starting to see kind of a bottom that had been put in, and so they're starting to earn money. And the stock price responded accordingly. So even GAAP earnings were rising. But you can see in the past, now analysts are pretty bullish, right, about earnings, but the market is saying no. So to me, again, this just goes in the too hard category. There's not a pattern here that it's a deeply cyclical business, so we know that. But when we go back to this big super down cycle in the oil industry, they never recovered from that. So when I look for a stock like this, if it's a cyclical, I want to see it recovering. I want to see that it's recovered. These peaks might not be reached again because this was basically like a big super cycle. But let's look at Valero. I used to own this one. I made a video on it back when I did own it back in 2021. So they're going through the same type of cycles. Big up cycle here, down, but earnings recover all the way. Then they go through this other horrible down cycle, and now earnings have recovered all the way again, a little crazily. But even this year, they recovered back to these peaks, okay? That's what you want in like a cyclical business. So when we go to buy this one at some point in the future, we want this stock price to be down. Maybe they have another down year, maybe Donald Trump pushes gas prices down or something, and they don't sell as much, or their margins are squeezed or whatever. And we get a down cycle, maybe something like back here, or even here, where it was at $70 a share. That's 50% lower than it is now. That's when you want to come in and buy. And then you assume eventually, the tide will turn and the cyclicality will turn around. I would much rather buy a business like this than buy one like Tidewater, where I have a lot less confidence in what the recovery is going to look like, how long it'll take to happen, on and on, okay? So that's my thoughts on Tidewater. This new format is screwing me up. Okay, AES. I think this is some kind of utility. Yeah, so you can see they have a ton of debt here. Like the total enterprise value is 4 times what the actual market cap is. And usually the market kind of ignores that for like utility type. It says, is it independent power producers? So I don't know exactly on the label if it's like a straight up utility or if they have something else special going on. But this 7 PE, I think the problem here is going to be that, So probably because of all the debt they have, this is what the actual like basic GAAP earnings look like. Much more cyclical, not like a utility, and you can see the stock price is like following that. So we can see this down cycle looks like it's starting, or the analysts expect it. Stock price is anticipating that by a year or two, already down. And so for me, the story here is almost certainly the debt. It's just too much. It's just too much debt, and now you could get a big rise when the market gets super negative and then it gets super positive, but it's always risky. So, even if you bought it like here and then you held it for 10 years or something, 8 years, you're only getting like a 4% return. It's just not worth it and very risky. I'm surprised they paid a dividend, but who knows? These type of businesses probably try to keep their investors, has a 5% yield. So they're trying to get dividend investors to kind of stick with them. But to me, this is mostly like owned by bondholders probably. It's just not very interesting. And the earnings here are not what's driving. The adjusted earnings are probably not real. I would just pay attention to these. That's what the market cares about. That's my initial take anyway. And I haven't really looked closely at the company at all. So if I say something totally stupid, that's why. You can remind me. People tell me in the comments when I really screw up, so check there. All right. So BMW. So I had a request for this. I didn't cover it in my auto video. Let's see if we can get rid of that. Well, first of all, we can see earnings were cyclical here. Obviously, Germany's dealing with a lot of industrial production problems right now. But maybe that's a buying opportunity, right? So we have a down cycle here, they came back, that's cyclical. Down cycle here, they came back, that's cyclical. Now we had what might be like some kind of super down cycle. It's really hard to tell, but I want to get rid of the earnings here, so I'm gonna do this so we can just look at the stock price from a cyclical perspective. So if we look at the drawdowns, this isn't, oh, by the way, this is from the German exchange. It's in euros, so we're looking at like a 65% drawdown here. That's probably deeper, closer to 70 or 75%, because I didn't click the exact top. I'm just trying to get and we have a bit of a blow off top here. So to this immediate drop is probably close to 50%. Not quite. I mean, let's see. Oh, we don't have 2015. Let's shorten this a little bit. Sometimes I can just look up there and do basic math in my head, but so we have a peak here, yeah, almost 100, and then it gets down. So yeah, more like 42. That was probably pretty accurate, actually. About 40% decline on just this little dip, but it never recovered. It never even really recovered to this high, which if you just decided this was kind of an anomaly, this little peak here. And then we have the real doozy of the whole COVID problem. And there it's down another more than at least 65%. So we have kind of the 65% level that's probably what I would put in my head if I was an investor looking to buy this during a down cycle. Now, if you buy at 65% of its highs, you can get a 200% return. I'll go show that in just a second. If it recovers to its old highs, right now we're down about 30. So to me, this can probably still drop another like 50%, honestly. The US isn't even in a recession yet. I know Europe is, some countries are. But if you do buy, let's see, if you do buy down here somewhere close to the lows, let's not pick that up, or let's just do this. So that's a 300% return in like 6 years, yeah. So that's what we want. If you're gonna take the risk of buying these and dealing with the pain of these horrible down cycles that happen, you want to at least get rewarded. I think if you buy it at a 65% off the high, you have a solid chance of like a 200% return, provided that the cycle recovers somewhat. So that's probably where I would aim with this one. Okay, GTLS. Chart Industries. I don't actually know anything about this company. Okay, so we know they're industrial machine company. Let's turn this back on. Historically, they've been very cyclical. You can see earnings have fallen. Let me shorten this real quick. Earnings fell from 260 down to 87, well over 50%, more like 65% maybe. And again, the same thing during the industrial recession. So just looking at this tells me cyclical business. I see their industrial machinery. This is what industrial machineries actually look like. Yeah, if you got sucked in near the top here, then you are down 90%. This is why you don't want to buy them when they're super at their peaks. You never know when the down cycle is going to come, another 90%. So this is a stock that can draw down 90%. It is near all-time highs. The market is very bullish. So I don't know what they do. Maybe it has something to do with AI or something now. I mean, you could look into it. It's possible. They have a decent amount of debt. I would say, and let's look at this decline in 2022. Over 55%, right? So that tells me not much has changed from these old cycles until this one, other than we haven't really had like a real down cycle yet. So extreme caution. I wouldn't be a buyer. I would be a seller if I owned it. I don't know what the stock price is going to do, but we do know it can fall fast. I mean, this downturn took, look, everybody thought things were wonderful all the way until August of 2008, right? It was at all-time highs, basically. And in a matter of months, in 6 months, it fell 90%. that's not something I want to experience. Now, at the bottom, I consider buying, okay? Because it looks pretty decent. Like, it's all recovered each time, each cycle for the most part. This one had a kind of a crazy top, but if you just kind of cut the top off of that a little bit, you get another peak kind of like this here. And so, you know, it's a decent deep cyclical, but you want to buy it probably 85% off its highs would be what I'd aim for. Now, I could miss something like this. It's important to point out. If they have some kind of new secular growth thing going on, then it could double, triple, or whatever from here. I don't know where the peak is going to be. If you bought here, you look super duper smart, right? Until, you know, what's that, a year or something, and you were up 100%. I mean, you look really smart until you lost it all. So it doesn't mean it can't go higher, and maybe this sign of secular growth is going to last, but historically it hasn't, and that's what I lean on. All right, Sony. Sony got just killed in the Great Recession, and it took years and years to come back. So this is really just too long of a recovery time for a cyclical business. And we look like now there's kind of some stability here, but there's just nothing. You don't know if this growth is going to last. The recent growth, the past couple years, let's shorten this. Let's go to 6 years. So we have $1.09 here. We have $1.13 here. That's basically no growth. 1, 2, 3, probably next year, not much, 4. So you basically have no growth for the business right now, with the possibility if there's a recession, it just plummets, and it's at a 20 PE. So that's an avoid for me. Not much upside reward looks like it anyway, and a lot of downside risk. So those are the ones I want to avoid. So Sony's an avoid for me. All right, MPW. I wrote an article on, this is Medical Properties Trust. This is a REIT. I wrote an article, I think it was a year ago, basically. If it wasn't a year ago, let's see. March. Yeah, it was right around when it was near the bottom here, like the very, very bottom. And the point I was trying to, this is an article on Seeking Alpha, so if you go search it, or you search Medical Property Trust and my name on the internet, it'll probably, that Seeking Alpha article will probably come up. A lot of people were into dividend, well, people still are into dividends, but they got attracted to these really high dividend yields, like 10% here going into, 2023, when the stock price just had started to fall. Even here, I think it was still 4. So this is when people really started going crazy for it during this decline. And I think the point of my article was people were looking at the yield, the dividend yield first. And when you do that and you're into like dividends, then it can influence how you view everything else. And so what I would say is, don't ever start with looking at the dividend yield first. These companies know that investors want dividends, and so sometimes they'll do whatever they need to do as long as they can, to the detriment of their business, to keep those high dividends, even though they don't make any sense. These guys had all kinds of problems with tenants and bad investments and all. I mean, you can go read about it if you want to. But my main point is, don't invest. Don't look first at the dividend. The dividend should basically be the last thing that you look at when you're trying to decide whether the capital allocation makes sense. So if a company's growing really fast, then they shouldn't be paying a dividend if they can invest in their own business, take that extra earnings and that they earn, put it back in their own business to keep growing at a faster rate. That's ideally what you want. Now, when earnings growth slows down, I generally prefer, if it's a mature business, for them to start giving money back as a dividend. If they can't find any place to put it to help grow, or they can't make an acquisition or whatever, it's just not very easy to do for them, or it's not available, or maybe the market's really expensive for other companies, or whatever else they need to do. If they can't invest that money well to get more earnings growth, then they should pay that's when they should pay the dividend. And so what I want to usually look at is, what is earnings growth? What's the earnings yield, and then how much of the earnings yield are they paying in dividends and buybacks. And then you can also look at debt. So those are basically the three main areas or acquisitions too, but those are the three main areas where they can spend their extra earnings. And usually I just want things to make sense. If earnings growth is high, I don't need a dividend. I don't need any stock buybacks, especially if the stock valuation is really high. But if earnings growth is slow, that's when I want to see dividends, because that means the company's maturing. It's probably not, and you want to get your money back out of the company so you can go find another place to invest that capital that maybe has faster growth. If you owned a business throughout its whole life cycle, you would want it to, if you just committed, I'm going to own this business forever, you would want it to either keep growing or to pay you out dividends once its kind of growth is slowed and it's returning that capital now back to shareholders. And hopefully you get enough dividends that's way more than you ever paid for the initial investment. But that usually takes a long time, especially in this market when everything's super expensive. But you don't want to say, oh, there's a 10% yield. Well, it's 10% for a reason, because the company is not going to be able to pay it. And they aren't. I mean, you can see the dividend has gone down and down and down. So, yeah, my main thing is don't start with the dividend. I mean, there's tons of other lessons, but like the main one is don't ever start out looking at the dividend first. The dividend matters last, not first, last. All right. Oh, that's the last one. Holy cow. Okay. I'm not sure how long this ran, but we got kind of a wide variety here, and you got to just get my quick take on all of them. If you found this useful, hit the like and subscribe button. If you have a request, I'll put the ticker on the whiteboard behind me. Usually I make full videos for most of them, and then if I build up a bunch of them where I can kind of just have a little bit to say about each one, I'll do them all together in a group like this. And then usually non-S&P 500 stocks I post on Patreon, so go check that out. There's a free tier there. I post all the same videos here on YouTube on the free tier over on Patreon. So if you don't want to rely on the algorithm to get my work in front of you, Patreon's a good place to do that. Those links are in the description. I'll see everybody later. Bye.